Hello, my name is Elliott Gue. I'm the editor of the Energy Strategist. I want to talk a little bit today about oil and natural gas prices, which have obviously been very volatile in recent months, and a little bit about some of the areas to look as potential buy candidates here over the next few months. Obviously, we've seen oil prices come down very, very sharply since early July. The real reason for this fundamentally has been concerns over the demand side of the equation, and basically U.S. oil demand and demand in a lot of other developed countries has dropped rather sharply, mainly as a result of a weak global economy, especially here in the U.S. What I think a lot of people aren't paying much attention to is the supply side of that equation. And what we are seeing is that oil demand is coming down, but oil supply growth has been very, very disappointing in many parts of the world, especially outside of OPEC. And I really do think that you're going to see supply come to the fore as a much more important issue at some point next year, probably in the latter half of the year. We start to see demand stabilize or demand decline stabilize. And at that time, I think supply is going to become a much bigger issue. On the natural gas side, the main concern here has been supply, not so much on the demand side. Demand for gas is pretty stable over the long term, especially in its use for electricity generation. But what we have seen is concerns that a lot of these shale plays, these unconventional plays in the U.S., like the Barnett Shale of Texas, the Haynesville Shale of Louisiana, the Marcellus Shale of Appalachia, etc., that supply growth from these basins would be so great that it would totally swamp out demand. So that's been the real concern there. There are some offsets to that, the main one being that a lot of companies really cut back their drilling plans. With natural gas prices where they are today, around $7 on the 12-month strip price, a lot of companies just aren't profitable at that level. Some of the publicly traded companies can still make money at that price, but you got to remember almost half of the land rigs in use in the United States today are owned by small, privately held, independent companies, and many of those firms just aren't profitable at gas at these prices. Therefore, they're cutting back drilling plans, and that should help to bring supplies or keep supplies well under control. And I think we could see an uptick in gas prices more towards that $9 to $10 region by the end of this winter heating season. As far as places to look, near term, I do expect we'll see a continued rally off the October lows in the market generally and in energy stocks. Longer term, I think one place to really keep an eye on is the income side of the equation. In other words, companies that pay large yields. Specifically, I would highlight master limited partnerships have been hit alongside the market here over the last 12 months or so. But the reality is fundamentally they have very, very little exposure to commodity prices. Most of them operate in markets like pipelines, regulated pipelines, almost a utility-like return. But the average MLP right now yields over 10%, which is is nearly double what they were yielding 1 year ago or in July of 2007 anyway. So it's a great opportunity to get into those. A couple other areas I'm looking at very, very carefully. One is the bond side of the equation. A lot of exploration and production companies in particular have bond issues out there. A little harder to buy than stocks or master limited partnerships, MLPs, but also yielding very high amounts, even though I think there's very, very, very little risk that you'll see any kinds of defaults out of those companies. A good example is Chesapeake Energy. Several bond issues out there. Very liquidly traded. You can buy them through most retail brokers. Some are yielding 12, 13% at the current time. Thank you very much for listening to me today, and I look forward to doing another one of these in the near future.